third segment of the first hour of the weekend edition. There's a mouthful of the Cornell Economics Report. We are still at the Silver Summit. This entire program is originating from the Silver Summit over here in Spokane, Washington. Boy, I'll tell you, got John Kaiser with me right now. John, I don't know if you feel the same way that I do. Probably not, because you live in Contra Costa County where the sun always shines. But we're getting some winter up here, man.
Yeah, I was amazed that they said, oh, it's going to be 37 degrees when we landed last night. And I said, oh, that's not quite the 60 that we're still having in the Bay Area.
Kathy and I went out jogging yesterday afternoon, and I'll tell you, I wish I had gloves and a hat. I mean, it's getting chilly up here. Markets are kind of chilly right now, too, John. You know, it's the resource sector right now is waffling. Most of our portfolio, fortunately, is in the green. But, you know, we're not seeing huge gains with any particular companies right now. I think people are standing on the sidelines because they're not really sure what, if any, difference the election results are going to make. They're not really sure what's going on economically, etc. What are your views on that?
Well, the post-crash rebound that began in April 2009 effectively ended 2 years later in April 2011. And we have been pretty much in a downtrend in the resource sector since then. We had a brief blip in September when QE3 kicked in, but even that has worn off. We're now seeing evidence that China is slowing down, bogged down by America's failure to get rolling again, and of course the European problems, which seem to be spiraling into a recession. The outlook now seems to be we might have a three-way Republican victory, and we enter into an age of austerity where we take the U.S. economy down deep to flush all the badness out of it, take the rest of the world down deep, and the expectation, of course, is that this will be very negative for base metals, precious metals, absolutely everything, which is why everybody's just sitting on their wallets right now in cash, $8.7 trillion in American household savings deposits right now.
What do you think the odds are of taking the American economy deep into the cellar and rebuilding it? What do you think the odds of that action actually occurring in the short term to midterm? What do you think the odds are? Let's.
You know, we've had 4 years of deleveraging where total debt, American household debt, has actually declined. This is about the time it takes after a major financial crisis such as we had in 2008. We are seeing evidence that the real estate market has stabilized. The $7 trillion net real estate equity that evaporated in 2008, that was a hideous reverse wealth effect. But now we actually see real estate prices rising, housing starts are rising. Unemployment has declined. Even the manufacturing sector, although it stalled in the last couple of years, added nearly 500,000 jobs since 2010 after losing about
a half a million. Yeah, the Obama administration is taking credit for adding about 500,000 new jobs to the economy, but unfortunately, as you brought out, that was on the heels of a 2-year major decline in employment of almost that same amount. I agree with you on the housing sector. I think the evidence is there that the housing sector is coming back slowly, very, very slowly. I think if anyone were to try to call a bottom in it, now would be probably about the time in that. The question that I have more, though, about employment, John, is I did a little bit of independent research, and the median family income in the United States over the past 4 years has gone down, not substantially, but it has gone down. So I don't know, the enthusiasm that you have for the employment, perhaps the manufacturing sector coming back, I'm not sure that at this point in time I would share that.
There are good reasons to expect manufacturing to undergo a renaissance. One is the shipping distances between Asia and now are very long. Oil prices are not going to be cheap. Even if we have our shale oil revolution, oil is fungible. It will trade at the price that the world price is. We have potential instability in the Middle East that could result in further supply shocks from that. So having your manufacturing close to your target markets is going to be good. The Chinese cost of production is rising. As their middle class emerges, they insist on quality of life rather than quantity of life. No more dumping emissions into the local neighborhood. Workers want health and safety. They want all those things we take for granted over here, where we here want to sort of turn the clock back a bit on that and deregulate things so that we can be a little bit more like China. But there's such a wide gap that that's not going to happen anytime soon. In addition, the shale gas revolution has created a glut of natural gas, which has resulted in very cheap electricity and a long-term stable supply of electricity. That asset China does not have. It has high energy costs. So there's a number of strategic reasons to reshore manufacturing either to the United States or perhaps to our neighbors to the south. So I'm optimistic that that trend will continue.
You know, it's interesting. I can't remember specifically when it was, but in the not too distant past, we did a show, and our guest at the time was also, interestingly enough, was Paul Van Eden. And Paul shares your opinion on that, which I think is very, very interesting. I don't think Big Al is quite there yet. And I'm not saying you're wrong. I'm just saying I think my time frame might be a little bit different. John, you specialize in resource companies. I've been investing in resource companies for the past 35 years. You know, I still think it's a pretty darn good place to be. What are your comments on that?
I issued a new bottom fish list on July 13th in the expectation that we would probably be bottoming in the last quarter. So I wanted to give my readers a heads up. Here are the companies that are going to be the survivors in the junior resource sector, and you should be treating this malaise in the market as an accumulation window. Personally, I think even if we have a three-way Republican sweep, we are not going to have an austerity-type program. We're going to have pretty much what Obama has already done, with perhaps a little bit less taxation. And the Republicans, the establishment Republicans, have no desire to crush this uptrend that is underway. So I think we're going to see the United States flourish. It's going to tow China out of this slowdown that it's in, and it's going to help stabilize Europe. So I'm quite pumped about where America is headed, provided we do not go into a let's create a depression to flush out the badness type mentality.
Well, I have to tell you, and I'm not saying this, John, because we're sitting here chatting, but you and Van Eden are probably two of the brightest guys who I know. So I put a lot of credence in what you're saying right now. You know, in terms of getting back to the exploration stage mining companies, which is certainly where my interest is, and that's certainly where your expertise is, I am happy to say that finally, not all, but most of the companies in our portfolio are in the green. And let me be perfectly specific. When I say in the green, over the past 6 months is specifically what I mean.
That must mean they're not bottom fish recommendations.
I think they are bottom fish recommendations.
Well, then they're at the bottom. They can't be in the green.
They're, you know,
they will be in the green.
Let me give you a couple of examples. You know, I just bought Orex Minerals, and I think that's one of your bottom fish companies. You know, I guess I need to be a little more specific on my time frame, but I would have to say, though, that really things are looking better right now for me in our portfolio in that area than they were 4 or 5 months ago.
Yeah. But Al, you're using math. Most of my bottom fish are also in the green, but the percentage is nowhere near what I'm looking for. I'm looking for 200, 300, 500% rebounds off these bottoms, and we're sitting on like maybe 10, 15, 20%, and that's not meaningful for me. I still call that red.
John, let me tell you, semantics are it's a very interesting concept. But no, I have to say I agree with you. But when I have a company that, let's say, I bought at 15 cents and it fell down to at one time 4.5 cents, you know, and now we're back up to 10 or 11 cents. To me, I will say I don't want to say I'm sleeping any better at night, although I probably am. But I'd have to say, to me, that's the beginning of a reversal. You got the final word, my friend?
I think metal prices are probably stable. They haven't collapsed. The game here is, are they going to stay at these levels, in which case we get a major inflection upwards for existing ounces and pounds in the ground. The other big story that's coming is the shift to discovery exploration, because if metal prices are stable, you need to start looking for deposits that have good grade and good size. And one area that I think is going to boom is the United States itself, which has been an exploration pariah for the past 20 years. That's where you should be placing your bets.
And there you have it.